Hello all, welcome to Get Into IAS, and in this video we are going to continue with the chapter Public Finances. Let's move into the topic. So now let's revise about the revenue expenditure, revenue receipts, capital receipts and capital expenditure. So under the article 112 we have the revenue account and the capital account. Fine. So this is for the central government. For the state government we have another article as we saw earlier. So under the revenue account, we have the revenue receipts and the revenue expenditure. Under the capital account, we have the capital receipts and the capital expenditure. You don't need to mug up what are all the receipts, what are all the capital receipts, what are all the capital expenditure, what are all the revenue expenditure. Instead, there is a simple trick to remember the receipts and expenditure. Fine. So this will be mostly reflected under your prelims examination. Okay. So every year, at least 1 or 2 questions will be reflected from this part of the revenue account and the capital account. Fine, I'll decode it very easily for you all. First thing is the receipts. So I already told you all what is a receipt. So the government of India receives money. So the government of India will receive certain amount of money, that is called as receipts. So under that, if it increases the liability, that is the government should repay something, that is called liable. I am liable to pay the money that I get from the bank. Okay, so that is the liability. If it increases the liability or if it decreases the assets. So in case if I am having 2 houses today, tomorrow I might sell one of the house. Okay, so this is the decrease in the asset. So if any one of the thing happens over here, that is called as capital receipts. So in a capital receipt, the government of India receives certain money. So accordingly, if it increases the liability or if it decreases the asset, it is called as capital receipts. Fine. So it is receiving money, that's why it is called as receipts. It is capital because it increases the liability or it decreases the asset. Next, coming to the next thing, that is the revenue receipts. So what is a revenue receipts? The opposite of the capital receipt is called as the revenue receipts. That is, if it does not increase the liability or if it does not decrease the asset of the government of India, that is called as revenue receipts. Fine. So these are the 2 things. So keeping this formula in mind, we'll see various examples for the capital receipts and revenue receipts. Fine. So example is, see, the government of India receives corporate tax. I already told you what is a corporate tax. The corporate tax it receives, right? It is a revenue for the government. It does not increase the liability. That is, the government need not repay the corporate tax back to the business firms, right? So it does not increase the liability nor it does not decrease the asset of the government. See, receiving the corporate tax does not decrease the asset of the government of India. So this comes under what? This comes under the revenue receipts. See, put this formula and see, this comes under the revenue receipts. Next, going to the railways. See, in railways, the government receives profits. Okay, this profit is called as non-tax revenue because it is not taxing anyone. So that is the profit of the government through railways. So this is a non-tax revenue. So receiving profits does not increase the liability. Tomorrow government of India need not repay the non-tax revenue. Fine. And this profit does not decrease the asset of the government of India. So this comes under the revenue receipt. So put this formula and see and check whether this comes under the revenue receipts, capital receipts. Fine. Now moving to the capital receipts. See, government of India issues government bonds. Why it issues government bond? Because it does not have sufficient money. Okay, it needs money. Like the same way, like if in case tomorrow I need money to run my business, I go to the bank, I get loans. Fine. Same way, government will also need money, right, for financing various things. So under that, it will issue government bonds. This government bonds is bought by us, we citizens. Okay, so it is bought by the market. So market force. So this increases the liability. Fine. Tomorrow, the government bonds issued by government, they should repay back the money because we are investing inside the government bonds. This money is going to government of India. Fine. So tomorrow, at certain maturity rate, this money should be repaid back to the citizens, right? So it increases the liability. So government should repay back the money. So going according to the formula C, if it increases the liability, it is called as capital receipts. You no need to mug up anything. Next, see, government of India receives loan from the World Bank for various development projects. Fine. So when it receives loan, tomorrow it should repay back the loan. So it is increasing the liability of government of India. So that comes under the capital receipts. Now coming to grants, take grants in aid. I already told you all about the grant in aid. That is, we get the monetary or material for free from various other governments or from the multilateral institutions. Okay. So grant does not increase the liability. Tomorrow government of India need not repay the grants. Next thing, it does not decrease the asset in case it is increasing the asset. So that comes under what? Revenue receipts. So this is how the question will get reflected in the prelims examination. Next, disinvestment. So what is the term disinvestment? See, today I have a house, okay? So tomorrow, in case if I need money for my hospital expenses, what I will do, see, if I have 2 floors in this house, I will sell the ground floor to someone. Top floor, I'll keep it, okay? So this ground floor, I have sold it to some other person. So this is called disinvestment. Selling the whole house is not called as disinvestment. Selling a part of your share is called as disinvestment. Fine. So the share is sold and then it will lower your ownership. See, earlier you had 100% ownership in this house. Now what is happening? You sold the ground floor to some other person and only you are having the top floor. And so your ownership only accounts to 50%. So what is happening? You are decreasing your ownership. So this is called as disinvestment. So what is happening here is, this is your asset. Your asset is getting reduced. So when your asset is getting reduced, see, go to the formula. Your asset is getting reduced, that is called as capital receipts. When your asset is getting reduced, it is called as what? Capital receipts. So disinvestment comes under what? Capital receipts. So by a simple formula, you can find out whether it is a capital receipts or revenue receipts. Now moving to the expenditure part, that is the revenue expenditure and capital expenditure. Fine. This is also very easy. See, capital expenditure means it is non-recurring. What is recurring and non-recurring? Recurring means something you have to do continuously in a periodic time. Non-recurring means one time if you invest, it is enough. So that is called as non-recurring. So one time expenditure is called as what? Capital expenditure. So creation of new assets. Like for example, Government of India will create new roads, new railways. So all this will come under the what? Capital expenditure. And loans to the state governments or UTs and all is one time. It doesn't give loan every month to the respected state, right? Gives a huge amount of loan one time to the respected state government or the union territory. So loans given to state government or union territory, road creation, railway creation, all this comes under the capital expenditure because it is creating new kind of assets. Fine. Okay. What is revenue expenditure then? So the opposite of capital expenditure is revenue expenditure, that is recurring. So this is not recurring, this is recurring. Revenue expenditure recurring means you have to do something periodically, either monthly, quarterly or yearly and so on. Fine. So for example, for the recurring expenditure is the maintenance works. For example, if you are a central government employee, every month you will get salary, right? That salary is disbursed from where? From the Government of India. For example, salary to the employee. Next is the interest payment. See, Government of India may be getting loans from various other governments or the multilateral institutions, as I said earlier. So for this, Government of India should pay interest every month. So this is a recurring expenditure. That's why it comes under the revenue expenditure. Fine. So these are all the important terms noted down under the revenue account and the capital account. So keeping in mind these two formulas and keeping in mind the non-recurring nature of capital expenditure and the recurring nature of the revenue expenditure. Fine. Now dealing with the next topic, that is the deficit. What is called as deficit? For example, when you take the income and expenditure, so the difference between the income and expenditure is called as deficit. Fine. So in case if I am earning 100 rupees, so 100 rupees is my income. My expenditure is 90 rupees. So I am spending less than my income. So 10 rupees I can save. Fine. Take another case. See, my income is 100 rupees, but I am spending, my spending tends to be 120 rupees. Look at this, I am spending more than what I earn. So 100, extra 20 rupees I am spending. Over here there is a deficit. So when the income and expenditure, when my expenditure is more than my income, there tends to be the deficit term. That is 20 rupees I will borrow from the market. Fine. So for buying a product, I am investing 20 rupees more than my income. So then what I am doing? I am borrowing 20 rupees from the market. So either from the banks or from the securities or bonds like that. So this 20 rupees accounts to be the deficit. So I think you got the point. When I spend something more than my income, I tend to borrow. So that borrowing term is called as the deficit. There is 20 rupees deficit for me. Fine. Okay. There are various types of deficit. Let's decode them. So there is a government deficit. First thing, what is a government deficit? So for government, there is revenue and expenditure. Same way as we saw the example for an individual, the government also tends to go in the same cycle. That is, the government will receive certain amount and the government will spend certain amount. So when the revenue of the government is lesser than the expenditure, that is called as government deficit. Fine. So the government is facing what? Deficit, shortage of money. So already we dealt with the last topic, that is the revenue account, capital account. Inside the revenue account we have the revenue expenditure and the revenue receipts. Inside the capital account we have the capital expenditure and the capital receipts. Fine. Now see, under the revenue expenditure we have the interest payment. I already told you all, revenue expenditure is recurring, day to day periodicals. Fine. So daily government tend to pay interest for the loans borrowed. Fine. That is revenue expenditure. And this is the largest expenditure of all. This revenue expenditure, inside the revenue expenditure, the government interest payment, day-to-day payment is the largest of all the expenditure. Next, coming to the capital account, inside the capital account, we have the capital receipts. What is the capital receipt? I already told you all, receipt is something receiving and capital receipt is the liability is more. Okay, the increase in the liability. When government borrows loans, it should repay back. So government is liable to pay back. Fine. So this is the debt of the government. Next, coming to the disinvestment. Disinvestment also comes under the capital receipts. So the government is receiving certain amount. But this disinvestment is not debt. It is non-debt capital receipts. We already dealt with that. So keeping this in mind, we will decode all the deficits. So the first deficit is the budget deficit. So what is called budget deficit is, see, it is the difference between the total expenditure and the total revenue. So the total expenditure minus the total revenue is called as the budget deficit. Fine. When the government's total expenditure is less than the total revenue, that accounts to the budget deficit. So you already know the formula for total expenditure. That is, the capital expenditure and the revenue expenditure is the total expenditure minus what is called as the total receipts, that is the capital receipts plus the revenue receipts is called as the total receipts. So when you minus all this, already we saw earlier, right, how to decode all this. So when you put all that together, you get the budget deficit. Fine. So under this, the capital expenditure and the revenue expenditure, you know, minus borrowing loans. So this capital receipts is, I am just decoding the formula for you all. See, capital receipts we saw about the loans. So borrowing, the government should borrow, that will come here, plus the disinvestment. Government, this disinvestment is the non-debt creating capital receipts. So this disinvestment will come here plus the total amount of revenue receipts. So all this clubbed together is called as the budget deficit. How much the government really needs to balance the budget, that is called as the budget deficit. So on year the government calculates the budget, right? So for that budget, how much is totally needed for the deficit? So that is calculated using the budget deficit. Next thing is the revenue deficit. Very, very important component under the deficit is the revenue deficit. So what is called as the revenue deficit? So the day-to-day commitment is not fulfilled. For example, I already told you all, daily the government will be spending on certain things. For example, the maintenance of roads, giving salaries, interest payment. So interest payment and all the daily revenue expenditure of the government. Daily government will be doing all these activities. So for this daily activity, government is not having sufficient amount of money for doing the expenditure. So that is called as revenue deficit. It is very critical under all the deficits. The formula for revenue deficit is revenue expenditure minus revenue receipts. We already saw about revenue expenditure, what are all the components inside the revenue expenditure will be clubbed together minus the revenue receipts. So this revenue account, the difference in the revenue account is called as what? Revenue deficit. And this is not futuristic. See, day-to-day commitments is not futuristic. For example, in case if I am investing in a road, so roadways or railways, on a future date that will give me certain amount of income, certain amount of revenue. But maintaining the roads daily will not give me a income. Giving salary to the government employees on a future rate, it won't give me an income. Paying the interest won't give me an income at the future rate. Correct. So all this money is going out of my hand. So this is called as revenue deficit and it's very important among all the deficits. Next, coming to the fiscal deficit. What is called as a fiscal deficit? So the total amount of money borrowed by government in one financial year to meet extra expenditure in revenue account and capital account. See, in revenue deficit, we saw the difference only in the revenue account, okay. So this is the day-to-day commitment of the government. But under the fiscal deficit, it is the total amount of the revenue account and total amount of the capital account is considered. So that deficit is called as the fiscal deficit. So normally one financial year is taken into account for calculating this deficit. So the formula for the fiscal deficit will be total expenditure minus total revenue. Okay, so total expenditure minus total revenue, almost it is equal to the budget deficit. But what is the difference here is, see, total expenditure is revenue expenditure and capital expenditure. You already know what is a revenue expenditure and what is a capital expenditure and what are the components inside that. So that is calculated minus the revenue receipts. You already know what is the revenue receipts. Okay, this revenue receipts plus non-debt creating capital receipts. What is non-debt creating capital receipts? For example, the loans won't come here. See, loans is debt creating capital receipts. Fine. Non-debt creating capital receipts, for example, disinvestment, that is taken into account. Fine. So all this is calculated and minused with the total expenditure of the government. That is, the total revenue is minused from the total expenditure. Fine. So what is a fiscal deficit is the day-to-day expenditure is also calculated and expenditure on the capital account is also taken into account. For example, the capital expenditure and the capital receipts are taken into account. So normally you have to keep all these three formulas in mind. First thing is the budget deficit, that is the total expenditure and total revenue of the government is taken into account. Revenue deficit is the revenue account, difference in the revenue account. Fiscal deficit is the same way as the budget deficit, that is total expenditure minus total receipts. And next one, the primary deficit. So then primary deficit is the fiscal deficit. You already know what is fiscal deficit. So now only I told you all what is fiscal deficit, that is the total expenditure minus total revenue minus the interest payment. So what is the interest payment is, see, so this year the financial year of the government is 2020 to 2021. So last year it was 2019 to 2020. Look at this. In this year, government will be borrowing certain amount, that is the loan. So for this loan, the government will be paying interest. So that interest will be continued in this year also. See, government will be borrowing 100 rupees last year, that is 2019 to 2020. Later what will happen? It will be paying 5 rupees interest on 2019 to 2020. After entering the financial year 2020 to 2021, it should be paying another 5 more rupees of interest. So, for paying that interest, the government is borrowing certain amount of money, that is called as primary deficit. I think you got the point. The primary deficit is the fiscal deficit minus the interest payments. What is actually the real primary deficit of this year is calculated using the primary deficit. Fine. So, the government is borrowing for the sake of the past loan. So, what is the definition of primary deficit is? For paying the past loans interest, the government is borrowing this year. This is called as primary deficit. Fine. So next, coming to the effective revenue deficit. So we dealt with all the deficits. Now dealing with the last deficit, that is the effective revenue deficit. See, this deficit, effective revenue deficit, was introduced in 2010-2011. Fine. What is it actually? See, the central government gives grants to various states and UTs. We already dealt with this, right? So central government will give grants to various state governments and the union territories. For what? These union territories and the state government will use that grant, that sum of money, to create certain capital assets. Like, see, if central government is giving for Tamil Nadu 100 crore rupees for creating roadways, fine. So this is a capital asset. This capital asset will give revenue to the respective state governments, but not to the central government, right? See, actually the central government is giving money to the state government, but the revenue is going to whom? To central government or state government? It is going to the state government, fine. So this is not a capital expenditure of the government. Actually it is a capital expenditure, but it is not a capital expenditure of the central government. It is a capital expenditure of the state government, but the money is being derived from the central government. And hence, the central government will not receive any return. That is, it will not receive any revenue from the capital asset creation. Fine. Next one, but it will contribute to the national income. See, this creation of capital asset like roadways, railways will give more amount of employment opportunities and it will give more amount of returns. So, in a way, it is contributing to the national economy. But it is not a capital expenditure of the central government. So the effective revenue deficit is calculated to be the revenue deficit minus the grants. So how many ever grants is given to the states, respective states or the UTs, that is minus from the total revenue deficit. So by this way, you will know how many assets are being created in the respective state governments and the UTs, and the total effective revenue deficit will be calculated. Fine. Next one is the monetized deficit. Monetized is from the word RBI. See, the government a lot of time borrows money from the RBI. So the monetized deficit is the borrowing from the RBI or withdrawing the money deposited with RBI. See, the central government, for meeting its various needs, it will withdraw the deposited money. It will be depositing certain amount of money, like how we deposit our money in banks. Same way, government will be depositing some amount of money with RBI. So that amount of money will be withdrawn or it will borrow from the RBI. So monetized deficit means borrowings from RBI plus drawdown. Okay. Fine. So these are all the deficits of the central government. Next, coming to the types of budget. Next topic. Now we've done with the topic deficit. Now coming to the types of budget. So first budget is performance program budgeting. What is called as performance or program budgeting? See, a certain amount of finance. So a monetary value is given. Money is given. Okay. So this is the input. Next, the physical output. See, for construction of a building, I should pool in some amount of money. So this money is my input. So after that, this whole asset creation, this whole building is my physical output. So this is the output I created with the help of the input. So in the performance or program budgeting, it is a state-wise planning. For example, take any scheme like take MG Narega, Mahatma Gandhi National Rural Employment Guarantee Scheme. So under this, the stage-wise monitoring of all the employees or asset creation will be calculated. So this is called as performance or program budgeting. Fine. Next, coming to the outcome budget. Outcome budget was introduced in 2005. So see, the same way, finance is the input. So physical asset is the output. This alone contributes to the performance program budgeting, but the full outcome is to be noticed. I'll give you an example for this. See, I am investing certain money. Take it as dollars or rupees, anything. I'm constructing dams. So in India, you'll be constructing dams, or US, you'll be constructing dams. So this dam is my physical asset. Fine. After that, with the help of these dams, various irrigation projects are carried out to the farms. Okay. The irrigation project should be increased, and by the irrigation, the income of the farmers should increase. For example, doubling the farmers' income within 2022 is the aim now, recommended by the Dalwai Committee. So Dalwai panel. So according to this, outcome budgeting means the money what you invest, the physical asset what you created should give a holistic outcome. The irrigation should be increased and the income of the farmers also should be increased. By that you will achieve a certain goal. So that is called as outcome budget. You are showing a definite outcome at the end. Okay. So next one is the zero-based budget. Zero-based budget is not in India. They are planning to implement in future. So 2019 and 20. There was a scheme in the budget. Fine. This was implementing throughout the year, financial year. Next, coming to the 2020 to 2021 budget, this scheme is not being continued. Okay. So this scheme is left out within that budget itself. In this year, they'll think why to bring about that scheme and was it effective in the last budget. So calculating all these only, they'll bring the scheme again. But the scheme will be introduced as a new scheme again. So it won't be the continuation of the old scheme. It will be brought from the scratch. This is called as zero-based budget. Starting from the scratch is called as zero-based budget. See, every year, previous year schemes and policies will be implemented in the next year. Okay, but in zero-based budget, the previous year's policy will not be introduced here. In fact, it will be introduced as a new scheme or new policy with various modifications. Fine. Next, so we are done with the types of budget. First thing is the performance program budget, stage-wise planning. Second thing is the outcome budget. Finally, you should achieve something. Zero-based budget is starting from the scratch. Next is the tax. What is a tax? Tax is nothing but it is a compulsory levy to be paid. For example, we pay income tax to the government. So this is a compulsory entitlement we should give to the government. So it is a compulsory levy to be paid. If you are paying, will we get back the tax later at a future date? No. So what is paid is paid. We won't get back at a future date. So no receiving back. Very important. Tax is something we pay and we does not receive it back at a future date. Fine. So examples of tax are income tax, corporate tax, excise duty, customs duty, property tax. All this we dealt earlier. Fine. Now coming to the tax base. What is called as a tax base? See, we have income tax, we have property tax, we have excise duty, we have wealth tax, we have under the income tax we have the corporate tax. So this is called as the tax base. The increasing of tax, that is the collecting of tax on various heads, is called as tax base. See, when they increase the tax base, government will get a lot of revenue from it. See, earlier if you don't have wealth tax, this was the tax base. Later when the government introduces this wealth tax, you will get what? Revenue from the wealth tax. So by this, the government's tax base, the people who are paying tax are getting increased. See, for production and manufacturing, excise duty is levied. Next, for income tax of the individual is collected. So by this, for each and everything, you will levy a tax. So by this, the tax base also, the tax base of the government will increase. That is, the revenue of the government through the taxation will increase. Next, coming to the very important term, tax buoyancy. So in prelims, there may be a question like, define what is tax buoyancy, or they may give you some other definition and tell you to identify the correct exact definition or term. So what is tax buoyancy? So you should understand the term buoyancy, fine. So the change in the tax revenue with respect to the GDP. How is it? See, tax buoyancy is nothing but proportionate change in tax revenue to the proportionate change in GDP. So GDP is gross domestic product, right? Whatever we create for one financial year, a production of goods and services for one financial year within the boundary of the country is called as GDP, fine. So when this GDP is compared with the revenue, tax revenue, that is called as tax buoyancy. For example, when the GDP increases, the tax revenue for the government will also increase. So in short, it is the relationship between GDP and the tax revenue. Fine. The revenue mobilization is done with help of the tax buoyancy. So when there is a growth of GDP, when there is an increase in GDP, see, last year GDP is 5% means this year it will be 6%. So subsequently there will be revenue, more revenue for the government. With that it will help the government to mobilize the revenue. So this is called as what? Tax buoyancy. Okay, and this tax revenue will contribute to the national income. That is why it is called as tax buoyancy. That is the change in tax revenue with respect to the growth in the GDP. So this is called as what? Tax buoyancy. So next, moving to tax elasticity. See, the tax collection of the government will increase in two variants. The first one is the tax rate. When the tax rate increases, the tax collection will increase. Second one is the GDP. We already saw about this in the tax buoyancy, right? So when the GDP increases, the tax collection also will increase. How? See, GDP is increasing means the production of goods and services in a country is increasing. Fine. So when the production increases means, it means the goods and services increases. For producing that goods and services, you need humans, right? So you are employing a lot of people in the production or the services sector. So by that way, the GDP will also increase. So this contributes to the tax buoyancy. Fine. So when the GDP increases, the tax collection also will increase. That is called as tax buoyancy. Then what is called as tax elasticity? Tax elasticity is the increase in tax rate. When the government increases the tax rate, the tax collection also will increase. For example, take the tax elasticity. When the tax rate increases, the tax collection also will increase. For example, in GST, goods and service tax is an indirect tax. So under this, we have various tax slabs. For example, we have 0%, 5, 12, 18, 28%. Fine. So these certain products will be included in the 28. Certain products will have tax of 18%. Certain will be 12. So like that. See, in a future date, when government increases the tax rate, this is called as the tax rate, okay? When increases tax rate to 1%, 7%, 13, 20 and 30, see the amount of tax rate is being increased. So for the products we get also, we will be paying more amount of tax. That's why they increase the tax rate. So by increasing the tax rate, more amount of tax is being collected. That is called as tax elasticity. So tax elasticity depends upon the tax rate and the tax buoyancy depends upon the GDP. I think you are clear with this point. Next, moving to the classification of taxation. There are three types of tax classification. First one is the proportional taxation, second is the progressive and the third one is the regressive. What is called as the proportional taxation? So the tax is levied uniformly. Take example, my income is 10,000. My friend's income is 100k. Fine. So my income is 10k, my friend's income is 100k. For both, the tax rate is 10%. I already told you all, this is the tax rate. So tax rate is 10%, 10%. Fine. So I'll be paying, so 10% of 10k is 1000 and then 10% of 100k is 10,000. So this tax rate will be uniform. This is called as proportional taxation. So the tax for everyone will be uniform in the economy. Next, coming to progressive taxation, take the same example. My income is 10k, my friend's income is 100k. For me, the tax rate is 10%. So 10% of 10k is same 1000 rupees. Next, this is the tax amount I'll be paying to the government. Next, when coming to the 100k, for him the tax will be 20% because he is getting a lot of income. So in this 100k, 20% is 20,000. So he will be paying 20,000 for his income. I'll be paying 1,000 for my income. This is called as progressive taxation. Depending upon the income, the tax is paid. Next one is the regressive taxation. Regressive means something that is negative. Okay, opponent. See, same way, my income is 10k, my friend's income is 100k. For me, the taxation is 10%, but for him, the taxation is only 5%. So I'll be paying 1,000, he'll be paying 5,000. But see, the tax rate for him is less. This is called as regressive taxation. Fine. Now coming to the methods of taxation of goods. How they'll tax the goods? First thing is ad valorem. So ad valorem is value of goods, the tax is levied. So for the value only the tax is levied. Very important. Value is valorem, ad valorem. So when you're adding value to something, the tax will also increase. See, for example, in 2017, the rate of this car was 2 lakhs. Okay, so I was paying 20,000 tax. Later in 2020, the rate of this car increased to 4 lakhs. So the value got increased. So I am paying more amount of tax. Now I am paying 40,000. So depending upon the value, the tax also increases. Next, coming to the specific duty. Specific duty is like kind of opposite to ad valorem. Specific duty is very specific. It doesn't depend upon the value. See, the car's value is 2 lakhs. I'll be paying the same tax. I'll be paying 20,000. Tomorrow, the car's value increases to 4 lakhs. I'll be paying the same tax of 20,000. So, the tax will be very specific. If today the tax was 20k, tomorrow also the tax is 20k. In case the value of the car has risen or not, the tax will be the same tax. Okay. But the tax collection will increase when we get 2 cars. For example, take this car, 2 lakhs. Okay, I'll be paying 20,000. Fine. Same car I'm getting for 2 lakhs. Another one more person, 20,000. So this tax amount only will increase depending upon the number of cars purchased and not upon the increase in the value of the car. So you have to understand these two things. Ad valorem means depending upon the value, the tax will increase, but specific duty, the tax will remain same even if the value of the car increases. So the tax collection will increase when the number of cars brought increases. When they get more amount of car, more amount of tax will be collected. Okay, fine. So now coming to the types of taxes, there are 2 kinds of taxes. The first one is the direct tax and the second one is the indirect tax. Moving into the direct taxes, income tax is an example of direct tax. For example, direct taxes are progressive in nature. You have to keep this in mind. Direct taxes will be progressive in nature because we already saw about progressive taxation. That is, depending upon how much income I get, so much amount of tax I pay. That is called as progressive taxation. So income tax under that corporate tax is there. So corporate tax is not a separate tax. It comes under income tax, as I said you guys earlier. Because the contribution of corporate tax is so high that we learn them in a separate subheading. Fine. Next, under the direct tax, we have securities transaction tax. So this was introduced in 2004 and 5. See, various companies are listed in the stock exchanges, right? So in that, if any transaction takes place in the stock exchanges, for that tax will be levied. That tax is called as securities transaction tax. Next one is the commodities transaction tax. Under this, tax on scale of commodities. So how much commodities you sell, depending upon that you have sold, depending upon that the tax is implemented. That is called as commodities transaction tax, which was introduced in 2013 and 14. Fine. So how much commodities I sell, so much amount of tax I pay. Next one is the minimum alternate tax. So this minimum alternative tax, that is MAT and AMT. These two are not separate taxes. This comes under the Income Tax Act. So what is minimum alternate tax? For example, take some companies, okay. Some companies, these companies does not pay a little amount of tax also. They do various tax evasion method, they show their profits low, they show the income low. So with the help of all of these, they don't pay taxes. So the ultimate motto of government is to make them pay at least a little amount of tax. That is why it is called as minimum alternate tax. Fine. So some companies escape the corporate tax or pay very low tax. So this tax was implemented from 1966 to 1967. Fine. So if a company does not pay any amount of tax or pay very little amount of tax, the government will make them pay at least a minimum tax, that is called as minimum alternative tax. Next, what is alternative minimum tax, AMT? So there are some partnership firms. For example, 5 people join together, they make a joint venture, they invest and then they make profit. But the profit will be huge, but when you split the dividend profit into 1, 2 and 3 for each person, the profit becomes small. So these people show the profit level or income level very low and they don't pay the tax or pay very little amount of tax. So to make them pay the tax, we have the provision called as alternate minimum tax. Fine. So next thing is the indirect tax. We are done with direct taxation, indirect tax. So indirect tax mostly are regressive in nature. Fine. See, today I'll go get a bat in a shop. Fine. For me also the tax is same. If a rich kid is coming and getting the bat, for him also the tax is same. So can you differentiate between the progressive and regressive tax? So normally the direct taxes come under the progressive regime. The indirect taxation comes under the regressive regime. So for example, 100 rupees is my income, I pay 10 rupees tax. 1000 rupees is my income, same way I pay 10 rupees tax. Fine. So this is called as regressive taxation. But to come out of this, for luxury items, the tax will be high. For essential commodities, for essential goods which are very, very essential. For example, during COVID, masks and sanitizers were put under the essential list. So for essential goods, the tax will be low. So this is a kind of a way that the progressive taxation to some extent is seen on the indirect taxation system. So normally indirect taxation system is regressive in nature, direct taxation is progressive in nature, but to ensure that the progressive nature is found in the indirect taxation system, luxury items have higher taxes, essential goods have lower taxes. Okay. Next indirect tax, that is the union excise duties. So for manufacturing any goods, we pay excise duties. So this comes under the indirect taxation system. Next, national calamity contingency duty. What is this called as? In case if you are going and getting tobacco in a shop or crude petroleum, you pay a kind of duty to the central government. That is called as national calamity contingency duty. So the amount collected will go get deposited in the National Calamity Contingency Fund and the National Disaster Response Fund. Okay, if there is any natural calamity in the future dates, they'll use the amount deposited in this fund for repairing the works. Next comes the sales tax. Sales or the value addition tax, VAT tax. So when you sell a commodity, tax will be implemented for that. So after the GST regime, goods and service tax regime, the sales tax was mostly abolished for all the products because all the products came under the GST regime. We saw the tax rates, right? So each product came under each tax slab. Over here, only few products like petroleum, diesel come under the sales tax regime. The sales tax is normally implemented by the state governments. Fine? Okay. So now moving to the next topic, GST, that is goods and service tax. So what is GST? It is a uniform tax throughout the country. See, earlier, this is a kind of indirect taxation system. Okay, we already dealt with the direct taxation system. Now dealing with the indirect. So under indirect tax, GST is an important regime. Fine. So it is a uniform tax throughout the country. Throughout the country in the sense, from top to bottom of India, east to west of India, we have one tax that is called as GST. So it was implemented from July 1st, 2017. Fine. So the motto of GST, what is the motto of GST? So it is a one nation, one tax, one market system. So we have one nation, that is India. In India, we have one taxation regime that is called as the GST, and it is a one market regime. Fine. So it is defined under which article of our constitution? That is Article 366, Clause 12A. Very important thing to be noted down. It is defined in our constitution under Article 366, Clause 12A. Fine. So what is GST? How it is defined in the constitution? So GST means any tax on supply of goods or services. Very important thing. It is any tax on the supply of goods and services. So if anyone is supplying us goods or services, for that they have to pay an indirect tax called as GST. Or both, except taxes on the supply of alcoholic liquor for human consumption. So GST is not implemented for alcohol. So I already told you all, under various tax slabs, that is 0, 12, 18, 28, we have tax slabs. So the maximum taxation slab is 28% for any product. Fine, but if we bring alcohol inside this GST regime, see, maximum taxation itself is 28%, but if this alcohol lies outside the taxation regime, that is the GST taxation regime, the rate of alcohol will be more. See, if I bring alcohol inside GST, it will be 100 rupees. But if it stays outside GST, it will be 128 rupees. So that's why alcohol is not brought under what? GST regime. It is implemented with the intention of simplifying the indirect tax. See, earlier I told you there were lot of taxes, lot of indirect tax, tax 1, tax 2, tax 3, tax 4. So for each and every time the government has to implement various amount of taxes. But if all these taxes are clubbed together and subsumed under a separate subheading, that is the GST, the taxation becomes easier for both us and the government, okay, for calculation and for paying. So it is implemented with the intention of simplifying the indirect tax. For example, earlier the center has implemented the central excise duty, additional excise duty, sales tax, countervailing duty. Countervailing duty is nothing but if someone imports a product from some other country, the product, right, it will catch up this market. So for that, countervailing duty will be implemented, will be levied on that product. So for that product, the countervailing duty will be implemented. Fine. So all these taxes which the center had earlier was subsumed under GST. Next, coming to the state. State had earlier the sales tax, entertainment tax, octroi tax. What is octroi tax? See, if I am going from Kerala, I have a truck. I am moving from Kerala and carrying goods inside this truck, and from Kerala I am coming to Tamil Nadu. So for the crossing from one state to another state, I have to pay tax. So that will go to the respected state government. I have to pay tax to the Tamil Nadu government. So for this I have to pay to the Tamil Nadu government. That is called as octroi tax. So all this was subsumed and brought under what? GST. Earlier, from where did we take this GST? Earlier we had the same module under VAT, value added tax. So earlier, before GST could be implemented in India, we had VAT, that is value added tax. The model of VAT is, it is only for goods. See, I told GST is for both goods and services. GST means any tax on the supply of goods or services. But earlier we had value added tax, right? That is only for goods and not for services. That's why we brought a regime called as GST, goods and services tax, which is implemented on both goods and services. For example, how can I simplify this GST for you all is, see, there is cotton, fine. So cotton is a raw material. For me to go and get cotton, I should pay tax for that first. So I am paying tax. This is tax 1. After that, spinning mill. So this raw material will be bought by whom? The spinning mill owner. Fine. So he has to pay another tax for that. That is the sales tax. This is tax 2. Then after that, who's making into a dress material or yarn, he will get the cotton from the spinning mill. Fine. So he has to pay again sales tax. So tax 3. See, for one product from cotton raw material to coming to the yarn, the tax has been paid thrice. Fine. So this is tax on tax. This tax 1, tax 2 and tax 3. So for one product, 3 times the tax has been paid. So this is called as what? Tax on tax or cascading effect. Cascading effect is nothing but I paid tax, but now again I am paying tax for the same product. That is called as cascading effect. Fine. So the next thing is tax paid on input is adjusted with the tax paid on the output. Very important thing on GST is the input tax credit system. That is the tax paid on the input is cotton here, is adjusted. So finally over here the tax will be adjusted when it goes to the consumer. So that is called as input tax credit. Fine. Next one, why was this GST brought down is, it is to put down the price rise. See, for example, so we had earlier the value added tax system. See here, I am paying tax 1, tax 2, tax 3. Over here earlier the raw material, the rate of raw material is 100 rupees. So after paying tax, see, 20 rupees I will be paying tax, 120. Next again when he is getting, he will be getting for 120 rupees plus again 20 more rupees he will be paying tax. So now the product's rate is 140 rupees. So now again after this yarn, he'll be selling it to the customers. So again 20 rupees tax. So 160. See, the price of the product went from 100 to 160 after value addition. So value addition is value added tax. They are adding value at each stages. For that also they are paying taxes. So the final product note is 160 rupees. But under GST, if you bring this cotton material under GST, the rate will be like around 115 or 130. So when comparing to this is less, right? So that's why to put down the price rise, the GST regime was brought in. So what are the salient features of GST? First one is single market. We already saw the motto of GST is one nation, one tax, one market. So single market. India should be brought under a single market, the indirect taxation regime called as GST. Next, no competition between states. See, earlier before GST could come, it was not a single market. Fine. So if there is Kerala over here, Tamil Nadu over here, there will be a different tax regime here, and the tax regime in Tamil Nadu will be very different. So what these two people will do, so they will reduce the price to attract more amount of customers. That's why no competition between the states, because it is a single market system. Everywhere the tax will be same. Next one. The price will be brought down. We already saw that component over here. To put down the price rise, the GST was brought in. So we will see about the tax slabs inside GST. So you already told about the tax slabs. So the first thing is 0% tax slab. Some items are not charged under the indirect taxation system, that is brought under the 0%. Next we have 0.25. For example, diamonds, right? They have a GST, goods and service tax of 0.25%. Next we have 3% for gold and silver, 5%, 12%, 18%, 28%. So the maximum tax slab is 28%. Fine. So under the GST regime, we have central goods and service tax, we have state goods and service tax, we have integrated goods and service tax. So central goods and service tax will be levied by the center, state goods and service tax will be levied by the states. What is IGST? See, there will be inter-trade. So all this is for intra. Over here, IGST, there will be inter-trade and commerce happening. For that, they will levy IGST, okay, integrated goods and service tax. Next, coming to the last part of GST, that is the compensation cess. Very important topic to be noted down here after COVID-19. See, what is compensation cess is additional tax. It is an additional tax. Already we are paying GST. But on top of that, an additional amount of tax is levied on sin goods. What are sin goods? For example, luxury items, cars, tobacco, alcohol, for all this we have additional tax. Okay, fine. The tax amount that is collected on these sin goods are called as additional taxes. What is happening is like luxury cars, aerated drinks, pan, tobacco, etc. This compensation cess is levied for a 5-year term. How much year? 5-year term from the date of implementation. That is from July 1, 2017. This additional compensation cess will be for the 5 years. Why they brought this compensation cess? See, initially states will see a decline in the revenue. When GST was brought in, all the states, like not all the states, most of the states were against GST because we had various kind of sales tax that was implemented by the respected states. So all that is subsumed and brought under GST, right? So see, earlier the states would be getting a revenue from the indirect taxation system of rupees 100. Fine. So now under GST, initially at the initial stages, this amount will reduce, say like 70 rupees. So the states will be getting the taxation amount 70 rupees. Earlier they were getting 100 rupees. Fine. So to compensate this only, the compensation cess is being levied on the, that is the compensation cess is being levied on the sin goods. Fine. So what is this 14% year on year increment? What is this called as? What is this clause called as? See, the center would see to that year on year the state is increasing from 100 to 114. Fine. See, now this year 2017 the base rate will be fixed to 100 rupees. Fine. Year on year this should increase to 14%. For the next year the state should have a revenue of 114 rupees. In case if the state is getting only 110 rupees, there is a 4 rupees lack over here. Fine. So this additional 4 rupees the center will provide to the states through the compensation cess. Fine. I hope you got the point. So that is what is called as the 14% to fill the gap for an assured 14% year on year. So this will be carried for the next 5 years from 2017. Okay. Fine. So this is called as compensation cess. So we've done with some of the topics related to public finances in this video. Let's continue the remaining topics on the next video. Thank you for watching, and please subscribe to Get Into IAS and follow our Telegram channel on the description box given below. Please click the link, and thank you for watching.